Good morning, everybody, and welcome to the Seiler Wealth Management video blog. Today is Thursday, July 28th. And before we go any further, I want to remind you we're doing a webinar tonight. It's Investing 101. It is for folks that are novice investors just starting out. I do encourage, if you have teenage kids, high school kids, young adults that are in college, it's going to really be a basic event. However, it's going to really define why you should invest, what you should invest in, and long-term aspects and long-term benefits of investing. So it's going to be really a great event. Starts at 6:30 tonight. It's very simple. I'm going to put a link out here on the Facebook. Click on the link, sign up. Starts at 6:30 tonight, and you can watch it from the comforts of your own home. And for the following 2 Thursdays, so a week from today and 2 weeks from today, I'm going to do our halftime report. It's the Seiler Wealth Management halftime report. We'll talk about what went on the first half of the year, what to expect the second half of the year. That's a great event, and that's going to be for the more sophisticated investor, for the more experienced investor. So please, you can sign up for that one, and that's on the website as well, stockdr.com. So there are numerous ways. You can click on the link for tonight, or you can go to the website and click on the events tab. All right, and we appreciate it. So let's talk about what's gone on this week. It's still all about earnings. And of course, we had a Fed meeting the last couple of days. They came out, didn't say much. They feel that the economy is chugging along at a decent pace, and certainly comments they made do lead us to believe that there will be an interest rate hike sometime. And the market is pricing in 25 basis points, 0.25%, but it looks like the likelihood will be in December. And of course, last December, the Fed had their first rate hike in years, and looks like it's going to be a year before that second rate hike. So we'll keep an eye on that. Now, they do have a meeting in September, but the odds are they're probably going to wait until December, although there'll be a whole lot of economic data prior to that September meeting that could change their minds, okay? So it's all about earnings, right? And the biggest earnings report early in the week was Apple. I came on Tuesday, the day Apple reported. Now, I came on in the morning, and I said, listen, the likelihood is Apple probably is not going to have a bang-out quarter, but the stock is a value down here, trading at less than 11 times earnings. It's a big-time discount to the S&P 500. They have a pretty good dividend, and I was a holder of the stock. Now, keeping in mind that we own it for clients, and most of our clients have a double in it. We've owned it for many years, but now we're just reaping the benefits of the dividends, and I do believe the stock will go higher over time. It's not going to be the biggest mover like it used to be in lead markets, but it's really a solid, I think it could be a solid return over time. So the day before earnings came out, which was on that Monday, and again, I like when analysts come out and make gutsy calls. You're going to be wrong as an analyst. I got it. So I'm not ragging somebody for being wrong. But it's unfortunate that his name is Colin Gillis, and with BGC, he came out and on Monday and said, hey, Apple numbers are going to be horrible. We rate the stock a sell, and our target's $85. Now, yes, the company came out with earnings. They beat expectation on the earnings and on the revenue side, and most importantly, they beat expectation on iPhone sales. They also beat on iPad sales. They were a little bit light on Mac sales, but really everybody was focused on the iPhone sales, and they did come out and exceed analyst expectation. That being said, the stock had the best day in 2 years. It was up over 6% in one day, trading above 103. Now, it had a problem over the last couple weeks getting above. It hit 100, get above by a few pennies, but couldn't stay above. But yesterday's volume and yesterday's action took the stock above, and it closed at 102.95. So good news for Apple shareholders. Doesn't mean that Mr. Gillis is going to be wrong. I don't know. The stock could go back to 85, but I look at value. If the stock goes to 85, it's even more valuable. Because remember, in this market, you got to find ideas that have limited downside, but yet can make you a good solid return going forward. And again, I don't know if you're suitable to own Apple. It's not as aggressive as it used to be. It's more of a chug-along type company. However, they do have 231 billion in cash. 231 billion in cash now. Unfortunately, most of that in foreign banks. I don't like that part of Apple. Hopefully, with a change in policy, we'll be able to get some of that money from overseas back into our country to help. But 231 billion. You know what that means? Just so you understand, the S&P 500 are the largest 500 companies in the world. Okay, Apple with 231 billion, it would be ranked 11th on the Fortune 500 list. 11th. So 231 billion in cash. So that's Apple should have another good day today. It's indicating a little higher pre-market. We'll see. Also, Facebook came out last night after close. It was just unbelievable. The company continues to just do great things on the earnings and the revenue front. I mean, we're talking a company that is just absolutely printing money. The stock was up pre-market. It's indicating about up 4% or so. You know, unfortunately, I've owned Facebook, and we bought and sold it over the last 2 years since it's public 3 times. Made a lot of money on it. I'm not in the stock right now, and that's unfortunate because it has done really well. But you know, we sold our last position around 113, and it's at 122 now. It's indicating to be probably around 126 or so. But again, it's one of those stocks where they keep delivering, and they knock the cover off the ball earnings wise, and that's what happens, folks. You know, it's supposed to be earnings and or anticipation of earnings that drives stock prices. In this case, we're seeing it. Google report after the close today, and the stock has been acting extremely well the last couple of days. Then also you see their counterparts, Facebook, Apple, Amazon, all looking pretty good. So looks to me that Google probably will have also a pretty good quarter. I want to take a step back and talk about something that I discussed a week ago this past Tuesday. Of course, the Pokemon Go craze is all over the place, and I said this is not going to last. This is a problem. Nintendo, which developed the game, was trading a week ago this past Tuesday at $37 a share. You can rewind my tape, go back to that Tuesday, and at $37 a share, I said, do not buy the stock. It is up on air, and I have serious concerns. Now, what I should have done is I should have shorted the stock, and if you short a stock, that means you're that negative that you believe it's going. And look, I knew it was going lower. I didn't short the stock. The stock went from 37 down to where it closed yesterday at 26.24. So that's a drop of almost 30% in a week and a half. So still, I don't believe it's a buy here, folks. I think this Pokemon craze is going by the wayside. And like I said 2 weeks ago, just wait till parents start getting their data bills from their cell phones and see if these kids are going over in data. First of all, playing the game, there's been a lot of accidents and a lot of things going on that it's dangerous because people aren't paying attention. So I think that's going to go away at some point. You're always going to have these games, but these are trends, and these are things that they're not investments. They are speculations, and I wouldn't touch it with a 10-foot pole. That being said, what I would touch with 10-foot poles, I love healthcare right now. The healthcare stocks are reporting some really terrific numbers. We took a position, and we disclosed it. We took a position in biotechs about a month and a half ago. I did biotechs, I did small caps. Remember when Brexit was coming around and I said, you know, let's own investments that don't care if the UK stays in the EU, okay? The biotechs have done great since then. And what's happened is, and remember my reasoning, biotechs typically outperform in the fourth quarter. And why is that? Well, because there's pressure on the FDA to get these drugs, pipelines up through clinical trials, phase 1, 2, or 3, or get them approved. So there is a lot that goes on here in Q4 because, of course, the FDA is going to shut down sometime early December. So it's a big push to get these things going. And the drug earnings are still doing very well. Biotech stocks, however, are the more risky, the more speculative part of the drug sector. These are the R&D type companies, and there's always a joke that, hey, biotechs will never miss on earnings. And you know why? Because they don't have any earnings. Okay, they get grants. They're working with investor money to come up with that miracle drug. And there's a lot of things going on in drugs these days. So we love biotech. We bought them. And I didn't buy individual biotechs. I bought them in the form of an exchange-traded fund. So by buying one security, I own a basket of biotech stocks. So they've done really, really well. I like that sector. I think the healthcare sector is going to continue to do well. And that's why portfolios tend to outperform. When you find that sector, because the market's the market. If you own the S&P 500, you're either going to be up or down a little bit, depending on what that index does. But what's the best performing sectors within the S&P 500? Well, over the last few months, it's been real estate. Commercial real estate, the REITs, have done extremely well. We own a few of those. I mean, not only do they pay nice dividends, but they do extremely well on the pricing over the last few months. It's been terrific. And healthcare, and those drugs, and biotech. So, like those sectors, please You can give us a contact us message, call, email, and we can give you some ideas. I don't give blanket ideas out on the internet because I want to make sure they're suitable for you. If you're not sure something is suitable for you, just check with your financial advisor or call us. We can kind of do a quick question and answer and determine whether these investments fit your needs, your risk tolerance, and your investment objectives. Okay, hope to see everybody tonight on our webinar. Starts at 6:30. It's Investing 101. And don't forget, next week is the Seiler Wealth Management Halftime Report. That's going to be a great event. So tonight is for the novice, the beginners. Again, teenagers are welcome. Get in there. That's fine. I want to help. And then next week is the halftime report. We'll talk about the politics of it. We'll talk about the economy. We'll talk about what direction to go here for the next 6 months. So anyway, thanks for joining us. Please share my videos. I really appreciate it. We're getting a lot of likes, a lot of sharing, and that's great because it's good information. And if I can educate, that's fantastic. If we can help you, that's great as well. I'm Lee Seiler with Seiler Wealth Management. Everybody have a fantastic day, and I'll see you tonight on our webinar.